Hi, and welcome to Extraordinary Pursuits, a podcast from BIP Ventures. I'm your host, Rochelle Kuramoto. Join me each week for masterclasses and conversations about the skills and experiences that matter most to startups in the innovation economy. You will hear from subject matter experts and founders. We're here to inspire, inform, and occasionally even entertain you. Let's get started. On this episode, we are joined by Mark Buffington. He is the CEO of BIP Capital and the managing partner for BIP Ventures. Recently, Mark wrote an article on a concept called the power law, and it has generated a number of questions and conversations. So we decided to invite Mark to join us for a discussion about what the power law is, how it works in venture capital, how it impacts founders and investors, and what everyone should be thinking about in terms of how funds operate as partners. This is a brilliant and insightful conversation. Let's get started. Today, we are having a conversation with Mark Buffington, the CEO of BIP Capital, about an article that he recently published on the power law. The article has gotten a great deal of attention and a lot of questions, so we thought that we would sit down and have a conversation about what it is and the role that it's playing for investors and founders. So thank you, first off.
Thanks for having me.
Let's get started by just kind of giving a general educational overview of what the power law is in venture capital.
In simple terms, the power law is this idea that the bulk of your returns, or the vast majority of your returns, will come from a small percentage of your portfolio. So, when I first started in the business 20 years ago, and started really studying the business maybe 25 years ago, I think you would hear commonly that 30% of the portfolio would generate 90-ish% of the returns for the fund. What I've seen transpire over the last 2 decades, particularly as institutions have made their way into venture capital in vast quantities, is a shift in that, where there's been this kind of accepted idea that 90+% of your returns will come from as little as 10% of your portfolio. So in other words, people are taking these massive home run bets, and if everything works out, they'll have one in 10 companies, maybe 2 in 20, that just drive these astronomical returns. So good fund returns. But what you've seen over time is those same funds that have adopted that strategy, they'll have one fund where they do an 8x overall, 8 times your money overall, but then they'll have the next fund vintage or series will be a 0x, so everybody loses all their money. And people have started playing that much more volatile game. So that's basically the power law and how it's shifted through time.
So that is, interesting and somewhat disturbing. And I think you have a perspective on the power law that is a little bit maybe contrarian to how other venture capital leaders tend to think about it.
Yeah, I mean, at least the guys that get all the press and that are doing all these exciting things. But the media in general is hyperbolic and has to write about dramatic things. And so the people that are doing that and have these wild wins, they get a lot of press. But what they don't, what the media does not do a good job of is, for every one Facebook, there's a million other failures that frankly, that all went to 0. And so it's, you're really playing a very low odds game if those are the bets you're making. And, to your point on me being a contrarian, probably so. I mean, as I study the industry, I think, like all good things, they get perverted over time. And as more people enter, the supply and demand changes. And so now there's, for many years, there was just way too much capital chasing, good ideas, and it was hard to find good ideas. And then even the subpar opportunities get bid up and they're trading at a higher price. We saw that, particularly at post-COVID, when all the stimulus went into the economy, 2021. But even before that, things were really starting to move to levels that I had not seen in multiples and valuations had moved to levels that I had not seen in my career. So, I think that's a function of the supply of capital chasing these kind of unicorns or deca unicorns or these huge outcomes. But
Yeah.
so our view is that if you really step back and analyze that, that this kind of shift from like absolute, not whale hunting, but like megadon hunting
Hmm.
or like, things that barely exist, if at all, has really, perverted outcomes for founders, but also for investors who are in the space. And so, I don't know if we're as much contrarian as more like factual and data driven on what optimizes returns.
Hmm.
And that's a function of what the magnitude of those returns are, but also what your batting average is within a portfolio. And so I would argue that there's very much an optimization there that everybody who shifted to the kind of lottery ticket approach to venture capital is missing out on.
Yeah, yeah. You do a really nice job in the article that we'll link to in explaining the concept of batting average. And I think, this concept, I think is often misunderstood, maybe because of the way that media talks about it or how well certain venture capital firms tend to market themselves and, tell stories. What do you think are the very clear realities of this approach, especially as you think about the impact on founders?
Yeah. So I think, what we've seen over the last at least decade, if not more, and, particularly our friends on the West Coast who, great admiration. I started my career there,
Mhm.
studied all the original pioneers out of Fairchild Semiconductor and all that, and have spent a bunch of time studying what they did. I don't think the business back then in the kind of, 70s, 80s, 90s was so driven towards these kind of, way outer right tail events that are like, drive 100x return, play for these big lottery tickets. I don't think the business was like that then, mainly because the people that were doing it were pioneers and they had their way of putting food on the table was to actually deliver consistent returns.
Mhm.
The game changed a lot when, institutional money came into the game. I think they wanted to be attached to, saying, hey, we invested in this fund who got into Facebook or who got into, LinkedIn or Uber or any of these big, mega billion-dollar exits. And but I think, what gets ignored and all that is what happens to founders if they take that money. I mean, I'm not going to name them, but we know plenty locally that have taken a check from some of the big West Coast marquee funds and they take, they have virtually no revenue or limited revenue and they take $50 million in, on a $350 million pre-money valuation, and they got like $1 million of revenue. And somehow, the people that make those investments think, oh yeah, this team's going to be able to scale up, and these people have never managed anything before are consistently going to be able to scale up. More often than not, a great idea like that is, turned into a binary outcome. In other words, if you take all that money, if you don't make it work while they're using it, burning money rapidly, you don't get another check, so it's over. And, I think founders need to think long and hard about, whether they really want that check,
Mhm.
particularly at what period of time.
Yeah.
In a weird way, every founder should want that check
Mhm.
at some point,
Mhm.
but not until they have product market fit, not until they have their go-to-market strategy down. And then you hit the gas. And absolutely, we're big fans of, once you're in that position where you have product market fit worked out, you have go-to-market strategy worked out, do what it takes to maintain the category leader status. But all too many times people try to, fund their way to category leader. And that's earned with the customers that you have, not, you're not usually with the amount of capital that comes in. The vast majority of people, mess that up when the pressure's on to go spend all that money. And every now and then it works out, but to me, not enough to optimize fund performance. And I think the data in that, the empirical studies, the academic studies would absolutely suggest that a lot of money gets wasted in chasing these kind of, far right, right tail outcomes. And the analogy I always make, I think I did it in the article, is like when you go to the casino, it's like playing Keno.
Yeah.
There's the worst odds in the casino, but it's
Yeah.
the machine that's flashing right up front.
Being shiny.
For whatever reason, when you get off the plane, you got to
Yeah.
go pull it to see if you're going to get the big ticket. But
Yeah.
it's a fool's bet for the most part. And
Yeah.
so,
Yeah.
there's a lot of that going on now in venture. So I think founders need to be, really thoughtful about where they take money, how much capital they take in, based on what their level of product market fit is, what their level of go to market sophistication is, and just where they are vis-a-vis competitors in the market. It's if you have limited competitors are doing something totally novel. Just had a conversation with a founder this morning who's doing something totally novel. If he's listening, hope he's not mad at me. I won't name him, but I had said, look, I think you're racing against yourself here. There's no other competition. Slow down, to really get these things right. You're not burning so much money that you don't have to raise more money and dilute yourself. And optimizing that for founders, I think, is very important. Something that a lot of times people trade off. Oh, I raised money from a tier one venture firm, but they gave away their whole life and their great idea and probably missed an opportunity. Maybe they have a very slim odds of making 200 million or something if it hits. But they gave away really predictable odds of making 30 to 50 million. And that trade-off, I think more founders should think about.
Yeah, I think you've made a lot of really good points here. I think, one that, in part this exists because we're wired to gamble. And you made that point well
I try to keep the
your
gambling
article.
to a minimum.
Yeah, absolutely. And you made the point about kind of taking the opportunity when the time is right. And, that may not necessarily be when the money is available. It may actually be when the right partner is available. And, you've made some very good points here and in the article that it's not necessarily the influx of capital that is going to tip the scales and in the to benefit a founder. It is what's happening in the market and having a partner that knows the right time for capital to come in. And so a lot of what I hear you talk about there is sort of this balance of, managing risk that, the inherently risk is going to come with taking in capital. Um, you know, what is your thought on, what role risk management play in this consideration of what the power law should look like, recognizing that all venture capital has a component of the power law involved?
Yeah, and it absolutely does. I think, I can tell you what we try to do. I wouldn't necessarily suggest to others that they follow our strategy. They're less, we wouldn't be that differentiated. But I think we try to explain all of those dynamics that really weigh in. All of those dynamics impact the probability of success. If you enter a market that is a red ocean and there's 15 entrenched competitors, and for whatever reason you're trying to do the same thing and you're not highly differentiated, either through technological innovation or business model innovation, odds are you're going to fail. And it probably doesn't make sense to go try to, throw tons and tons of money at that to, overcome somewhat low odds of success. I don't think that works. And, I think on the, and then, the other thing is if you just have a team that's not fully built out, that's not ready to go to really sell at scale and at pace, those are all things that reduce the odds of success. And so we try to blend all of that. As you well know, we have something we call the track horse jockey framework, the track being the market, the horse being the business model and the business proposition, and then the jockey being the leadership team that's guiding that horse on the track. It's been our experience that I don't care how good the horse and the jockey are, if you're running on a really bad track, the outcomes are going to be fairly diminished. If you're, that said, great jockeys and great leaders can do amazing things even in tough markets, but still the outcomes are generally suppressed, significantly suppressed, in a bad market or bad track. The flip side is also true. I mean, we've gotten involved in, into just great tracks, fast markets, right timing, and that will, oftentimes just, the customers will come just grab product out of your hand. They just pull it out of your hands, and and a lot of times, mediocre management teams look great because they're in the right market at the right time in the right place. It's hard to judge that if you're not sophisticated in measuring things like the efficiency of go-to-market, the win rate. There's hundreds of metrics to determine that. But I think we try to analyze all that and then come back to founders and our partners or potential partners and give an honest assessment of where we see the gaps, where we see the risks. And then, hey, we're partners in this. Let's go solve those problems together. We don't have to have all those answers as like checked and they've already addressed them. I mean, that's what, in many ways, that's what we do. We help founders build businesses, but that's a tough thing to do if they want to build a contemporary house and we want to build a French country house, or it's like you don't want to be arguing all the time on those things. So getting alignment is important, and assessing the risks and the gaps is super important. So that's I think we try to mitigate or flatten the power law curve, if you think about it, just from a mathematical standpoint. In other words, we're putting more probability in the larger outcomes by building consistent. Hopefully we get the track right, but by building consistent and durable horse and jockey and leaderships and helping them improve that, that's how we increase our batting average. And at the aggregate level in a fund, we're basically flattening that exponential curve, and there's more probability that we're generating 3 to 5 to 10x returns. My view on the 25x plus or 50x returns is, by the way, you can do all that stuff, and you probably increase the odds that you're going to get the 25 to 50x. But a lot of that is a little bit of luck, a little bit of timing. A lot of times at the certain market and the right thing, you'll be surprised. It just drags you into this new sphere. And we've been fortunate enough to have, a fair number of those. But I can't ever predict when we're doing the deals, really. I mean, I know we're in a big market or whatever, but it's hard to predict like, oh, this is going to be a 25 to 50x. I think we can consistently, or much more consistently, predict whether something will be a 3, a 5, or even a 10x. But it's funny, after I wrote the article, I had one of our oldest investors. I mean, they trusted us when we were just children with their money, and they've done really well. But he's still just the same person he was 20 years ago. He's always asking tough questions. He's like, wait a minute, does this mean you're giving up on the 25x's? Not at all. But what we're saying is we don't organize our fund for, where we're going to lose 90% of the time. And then, on the, hopefully have 10 to 20% of the capital in for a 25x. We're much more hoping to do, 60% of the fund generates 3 to 5x's. Maybe a couple of those end up being 10 to 15 to 25x's. And then we'll scramble and manage accordingly, just like other venture funds on the other 40% of the entities or companies that we invest in. And hopefully we can turn half of those into just to get our money back, and the others we're probably going to write off. And that's just the nature of venture capital. So anyway, I hope that answers your question.
No, it definitely does. And I think it brings up a couple of other sort of, questions. And I think we've talked a lot about the impact on founders. And, this idea that, they go into this maybe knowing that they're not going to be a unicorn. And I would imagine that you have definitely managed some emotions. You mentioned an investor, someone who's been with the fund and the firm for a really long time. What are kind of high level, what is the impact of like an extreme power law on venture capital investors? I mean, what should they be thinking about?
Yeah, this is a great question. By the way, not at all contrived or not. I love the question, though. I think, one of the things we have to guard against, we're at BIP Capital, we're fiduciaries to the funds.
Right.
But it's never lost on me that we're representing, either institutions or family offices or high net worth or, accredited investors, but human beings that have worked hard for that money and, want to invest in it. What I find, particularly with kind of the high net worth individuals, is that if you generate a couple 25x's or 20x's or 8, whatever the numbers are, 18x's, and we've been fortunate enough to do that a couple times, more than a couple times. But once you do that, in many ways you have their trust for life. They're kind of hooked, and those are life altering events for the founders and the management teams that we back and support. But they're also, in many cases, life-altering events for our investors, and it puts them in a different realm and a different level of financial security. And And once you do that with people, you have their kind of trust for life. I mean, my favorite investors are the ones that trust, but they're still verifying. They're calling and asking questions. Hey, what about this? Or yeah, totally.
Yeah.
And that the investor I reference falls into that category. But so it's common. I mean, it's but we have to be conscious of the fact that human beings, once they trust somebody and you've built that kind of wealth, they may become less discerning, and we can't abuse that. And I think constantly, like the other challenge we deal with is, particularly with some of these folks who've made a lot of money, more than they expected when they invested. They'll then want to flood money into deals, and you're in a weird way. We're having to say, no, most funds that are out raising money will take whatever they can get, and a lot of times we have to say, hey, spread that out. Don't put that much money in this one deal.
Yeah.
And so it's the same. I don't want to subject, our investors to too much of a power law in one fund or the other.
Yeah.
They should spread it out, diversify through time, diversify across names, but not be overly diversified. I mean, there's a saying in our industry, I kid around about this, but diversification is the game of millionaires. Concentration is the game of billionaires. I think somewhere in between that is the right strategy for fund management. And if you want to get it right, we're slightly concentrated, particularly into our winners, but not so much that we get absolutely wiped out if things don't go the right way. And we tend to create that concentration across time when we know more and more about the investment. So, but I think, it's a really good question. I mean, I think as we think about our LPs and the relationships we build, that those relationships are precious, and we can't ever forget that. And we, particularly those who've been with us for a long time, I recognize that they greatly trust us, and that if we're not careful, we could abuse that consciously and subconsciously. So we have to continue to push our process and make sure that we're acting with a strong kind of stewardship mindset. So,
well, and I think everything I hear you saying really references intentionality and skill. When you think about this idea of power law and the aggressive power law versus maybe just recognizing that it's a component of venture capital, how much of venture capital success do you think is attributed to skill versus luck?
As I mentioned earlier, I think the big magnitude wins have a degree of timing and luck. I think the consistent 3 to call it 6, 7, 8 X's are skill.
Those are skill.
It's doing the same thing over and over again to help build and scale businesses. And it's just, one of my partners says, it's kind of like building a house. You have to pour the foundation first. Then you have to build, all the internal, the electric, the plumbing. Then you put in the drywall. And a lot of times what we see, it's a very simple explanation, but a lot of times we see people kind of half pour the foundation. They kind of ignore the plumbing and the electric. They start putting up the drywall. Everything looks good, but it's really not a house that's built to last.
Yeah.
And I think, doing that right and thoughtfully with our partners, our founder partners, and the management teams we partner with is critical. And if you're able to do that consistently over and over again, again, there's still some power law effect in what we're doing.
Right.
But I think 60 to 70% of the time we'll be successful. And if you just look at our history, and outcomes on percentages of dollars that we put to work in venture, a huge number, almost $4 and $5 that we put to work, we've at least gotten back. And that's almost unheard of in venture. And then when you start looking at the probability that's gotten a 3X or a 6X or a 9X, those are fat tails. And we've been able to, drive a much higher percentage of those, but not because I think we're that much smarter, or I really don't. I think it really because we follow our process. We do it over and over again. We continue to improve it, continue to bring talent to the firm that helps connect with founders that have experiences that are worth sharing with founders. And that's what we do over and over. And I read a really resonated with me. I'm going to respond to it on Twitter, but Gary Tan, who's leading Y Combinator now, said that, hey, when Paul Graham and the firm was started under those folks, their main objective was to have their partners spend almost all of their time with founders, helping them build success. we have a similar motto here. It's we're partners in problem solving.
Yeah.
And as you well know, you've been a startup, your husband's been a startup.
Mhm.
If you enter into the startup world, you're going to deal you almost have to become a professional in problem solving because you're going to deal with like 5 a day.
Yeah.
And it's really like you're just constantly putting out and solving brush fires. And
Yeah.
every now and then there's a wildfire that you got to figure out how to put out.
Yeah.
So I think, we built our business model on that, and that part's skill.
Mhm.
And really being clear-minded about what is expected, what the nature of the partnership is with the founder.
Yeah.
And our approach is not for everybody. There's plenty of founders that are kind of like, give us the money and then, leave me alone and let me do my thing. And, but there's plenty of founders that want to thoughtfully build their business with great ideas that we can go build, investments and then companies around.
Yeah. No, I
That
think
has been great. So I think it's a combination of luck and skill.
Yeah, I think so. And I hear a lot of people. It's a combination of luck and skill and the right people. That is a huge that human element is huge.
For
And
sure.
so I think that the last question that I would ask here, goes back to something else that you've talked a lot about, which is AI and the role that AI is playing in all of this. And so, with the you've talked about data and how important data is in a solid batting average and really creating, outcomes of success. And we have greater predictability now thanks to, AI, and it's continuing to emerge. I mean, do you have a sense of how that is going to impact the role of the power law in venture capital going forward?
Yeah, but that's a good question. I haven't thought about it through the sense of like how it will impact power law,
Mhm.
but I just theoretically, if you're more accurate with data,
Mhm.
you know more faster. So
Mhm.
you're forming intelligence about the markets you're operating in, or about how a given go-to-market strategy is working. Theoretically, you should eliminate those errors quicker,
Mm.
and therefore the power law should flatten, and the probability of wins should go up. On the flip side, if everybody else is using it,
Right.
they're making those adjustments faster as well. So,
Right.
my guess is the way the world will play out in the future is that those who adopt the tools and can make fast decisions
Mm.
and augment humans to make better decisions and to deal with the human side of it, automate as much of the kind of information gathering, but also synthesis part of it,
Mhm.
so that they make better decisions are the ones that are going to win. And those that, for whatever reason, think that they can just pick, or that they're just going to outthink somebody with really powerful AI, I think those people are ultimately not long for the world, and won't be in venture capital for very long.
Yeah.
And I do think that the industry is going to change over the next 10 years. One of the barriers today is data. And I was reading a paper this morning about, right now, all the AI stocks are really bid up on a multiple basis. But a lot of the picks and shovels around AI
Yeah.
have still traded at historically similar multiples, and the data plays and the like. And,
Yep.
but there's no other way to look at it. If the petroleum, or the unrefined oil of the world today is data,
Mhm.
and was what is going to empower the AI engines. And if you just look at who makes all the money in the oil industry, it's the people who have the raw material,
Yeah.
not the
Right.
people who are refining it. And
Yeah.
so I'm not saying that there won't be amazing winners in AI that are refiners. I
Mhm.
think because the amount of data that will go into these systems, the raw materials, I think what you'll find is, you know, some set of raw materials about one set of subjects, let's say financials,
Mhm.
and another about go-to-market strategy, and another about human reaction to markets and how the markets are reacting to a given product.
Mhm.
To really synthesize that into something meaningful, one is going to need to have all of that data feeding into a large system. And, we don't see anything like that out there right now, but I think those who own a broad swath, plethora of data and meaningful areas going forward are going to be huge beneficiaries of the AI movement.
Yep.
So,
Yeah.
so that's, my guess is it'll, theoretically on a micro level, it should flatten
Mhm.
the power law,
Yeah.
but others are going to use it. So I
Yeah.
think things are going to get more competitive. And my
Yeah.
guess is the haves and those who are adopting it will flatten the curve, and the have-nots will steepen the curve, which means they'll have much more failure, and they'll be lucky if they get big wins going out of it. So, for sure, AI is going to make the world more competitive and concentrate wins and frankly, power in the hands of the people who know how to use it.
Yeah, sounds like a common story for a lot of sectors. So,
Yes.
well, this has been really, really interesting and helpful. We will, like I said, post your article. We'll also link back to your article on AI because I think that there's a lot that's germane there. Thank you so much, as always, for just sharing everything you know.
Awesome as always.
All right.
Thanks.
Thanks so much for tuning in to Extraordinary Pursuits. If you enjoyed what you heard, please like and share the show. It helps others to find us. Now, let's go build the future of the innovation economy.